You walk into a bank, you ask for $50,000. They check your credit, nod politely, and wire the money to your account. Here's the question nobody asks. Where did that money come from? Not from the vault, not from other people's deposits, not from some Federal Reserve warehouse stuffed with cash. It didn't exist 10 minutes ago. The bank just created it out of nothing with a keystroke. And that's not a conspiracy theory. That's how the system works. Most people think banks are middlemen. You deposit money, they lend it to someone else, they pay you interest, they charge the borrower more interest, and they pocket the difference. Clean, simple, logical. Except it's completely wrong. When you take out a loan, the bank doesn't check if they have your $50,000 sitting around. They don't shuffle money from one account to another. They open a spreadsheet, type 50,000 next to your name, and that's it. New money, created instantly. This isn't a fringe theory. The Bank of England published a paper in 2014 that said it outright. When a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The Federal Reserve has said the same thing. The Bundesbank in Germany. Central banks around the world have confirmed it. And yet, if you ask 10 people on the street where loan money comes from, 9 of them will get it wrong. Because we've been taught a fairy tale. Let's rewind. Imagine it's 1925. You walk into a small-town bank. The banker knows your family. He opens the safe, counts out your loan in cash, and hands it to you. That money existed before you walked in. It was physically there. That system is dead. Today, money isn't cash. 97% of all money is digital. It's numbers in a database. And when a bank makes a loan, it doesn't move those numbers from one column to another. It adds new numbers to the total. Here's how it works. You apply for a mortgage. The bank approves you. At that moment, 2 things happen simultaneously. First, the bank credits your account with the loan amount. That's new money. You didn't have it before. The bank didn't have it before. It simply appears. Second, the bank records that you owe them that amount plus interest. You now have a debt, and the bank has an asset. Both sides of the ledger balance, but the money supply just grew. This is called credit creation, and it happens every single time someone takes out a loan. Car loan, student loan, credit card balance, mortgage, business line of credit. Every one of those transactions creates new money, which raises an obvious question. If banks can just create money whenever someone borrows, why isn't everyone rich? Because there are limits, just not the ones you'd think. Banks can't create infinite money because of reserve requirements and capital ratios. But here's the thing, those limits aren't nearly as tight as you'd imagine. In the US, reserve requirements were dropped to 0 in March 2020. 0. A bank doesn't need to hold any reserves against new loans. Technically, a bank with $10 in deposits could issue $1 million in loans, as long as it meets capital requirements. Capital requirements are more serious. They say a bank has to hold a certain percentage of its loans as equity, roughly 10%, depending on the type of loan. So if a bank issues $1 million in loans, it needs about $100,000 in capital. But that capital doesn't have to be cash. It can be assets, property, other loan, and those assets are often valued optimistically, which means the real constraint on money creation isn't a vault full of gold. It's confidence. If people believe the bank is solid, the system keeps running. If they don't, it collapses. Now let's follow your $50,000 loan through the economy. The bank creates the money and deposits it in your account. You use it to buy a car. The car dealer deposits that $50,000 in their bank. That bank now has $50,000 in new deposits. And because banks can lend out most of their deposits, that second bank can now issue, say, $45,000 in new loans. That borrower spends the $45,000. It gets deposited somewhere else. That third bank lends out $40,000, and on and on. One $50,000 loan can cascade into $200,000, $300,000, even $500,000 in new money circulating through the system. Economists call this the money multiplier effect, and it all started with a keystroke. Here's where it gets uncomfortable. If banks create money when they issue loans, that means the total money supply is directly tied to how much debt exists. More loans equals more money. Less debt equals less money. In the US, total household debt is over $17 trillion. Corporate debt is over $18 trillion. Federal debt is over $33 trillion. The entire economy is built on an ever-growing mountain of obligations. And if people stop borrowing, the money supply contracts. Businesses close, unemployment rises, prices fall, deflation sets in. The system starts to eat itself. So the system needs you to borrow, not because banks are greedy, because the economy will collapse without new debt. This is why interest rates are the most important number in modern finance. When interest rates are low, borrowing is cheap. People take out loans. Money gets created. The economy grows. When interest rates are high, borrowing is expensive. Fewer loans, less money creation. Growth slows. But here's the trap. Every dollar created through a loan has to be paid back with interest. That interest wasn't created. It doesn't exist in the system. So where does it come from? From someone else's loan. The only way to pay back debt with interest in an economy where money is created through debt is for someone else to go into debt. It's musical chairs with money, and there's always one less chair than people. Let's talk about what happened in 2008. For years, banks created money by issuing mortgages, millions of them. Housing prices rose because more money was chasing the same number of houses. People borrowed against their home equity. That created more money, which pushed prices higher, which justified more loans, until it didn't. When housing prices stopped rising, the whole loop reversed. People couldn't pay their mortgages, banks foreclosed, borrowers defaulted, and because the money had been created through loans, when those loans went bad, the money disappeared. Not slowly, fast. In 2008, the money supply contracted for the first time in decades. Banks stopped lending. Businesses couldn't get credit. The entire economy seized up, not because people stopped working or factories vanished, because the money evaporated. The government's solution: create more money. The Federal Reserve bought trillions in assets. Congress passed stimulus bills. Central banks around the world did the same. They flooded the system with money to replace what had been destroyed. But that money didn't come from taxes, it came from more debt. Now zoom out. If money is created through loans, and loans require interest, and interest require more loans, then the system has to grow forever. There's no equilibrium, no steady state. It's exponential or it's collapsing, which raises a question nobody wants to answer. What happens when growth stops? Not slows, stops. Because at some point, people run out of things to borrow for, or they're too indebted to borrow more, or interest rates are too high, or wages are too low, or trust in the system breaks. And when that happens, the money supply contracts, not because anyone decided to destroy money, because debt is being paid off faster than new debt is being created. Japan has been fighting this for 30 years. Europe is flirting with it. The US keeps delaying it by issuing more government debt. But government debt has limits too. At some point, investors stop buying bonds, or inflation gets out of control, or political will collapses. And when that happens, the entire architecture comes into question. Here's the really strange part. This system isn't natural. It's not how money worked for most of history. For thousands of years, money was a physical object: gold, silver, shells, cigarettes, and prison camps. It had to exist before you could lend it. The system we have now, where banks create money by issuing credit, only became dominant in the last century. And it's only possible because we all agreed to pretend that numbers in a database are real, which they are, until they're not. In 1971, the US ended the gold standard. Before that, dollars were theoretically backed by gold reserves. After that, they were backed by nothing except trust. Trust that the government would limit supply. Trust that banks would stay solvent. Trust that the system wouldn't collapse. So far, that trust has held, mostly. But every financial crisis is a reminder that the whole thing runs on belief, and belief is fragile. So when you take out a loan, you're not borrowing someone else's money. You're conjuring new money into existence. You're expanding the money supply. You're adding to the total stock of debt that holds the economy together. And the bank isn't taking a risk by lending you their money. They're taking a risk that you won't pay back money that didn't exist until they decided you were trustworthy. It's not fraud. It's not a scam. It's just how the system works. But it does mean that money isn't what you think it is.
It's not a static resource that gets moved around. It's a dynamic ledger of obligations, a web of promises, a collective hallucination that only works if everyone keeps believing. And the moment that belief cracks, everything breaks.
The next time you see a bank, don't think of it as a vault. Think of it as a printing press, one that's turned on every time someone signs a loan agreement. And ask yourself, who really controls the money supply? The central bank, the government, or every person who decides to go into debt? Because the answer might be more distributed and more fragile than you thought.